Hi, I hope you all are doing really well. This is Ritika and we are doing reading 30th of corporate issuers called cost of capital. This is LOSB, which requires us to describe how taxes affect the cost of capital from different capital sources. This is a very small one, so let's begin without any further delay. There are three components of capital, that is debt, preferred equity and common equity. The preferred stock and common stock dividends are paid after tax, so tax does not have much impact on it. Once the tax is paid or the amount of tax due is assessed, it doesn't matter how much of the remaining profit is paid as dividends to the common stock and preferred stockholders. The servicing cost of debt, however, is deductible for the tax purpose. Thus, its real cost to the company is reduced by the amount of tax saved due to the interest saved. And hence, the actual cost of debt to the company is this. So you reduce the amount of tax because when you calculate the taxable income, the amount of interest you pay for the debt is reducible. So on that amount, that is the amount that you pay as interest, the tax is not payable. So this amount acts as a tax benefit. You don't get any such benefit when you pay dividends because dividends aren't deductible for the taxation purpose. Is that clear? Don't worry, I'll explain this with the help of an example. Suppose a company has taken 10% loan and falls in the tax bracket of 40%. Now using this formula, the loan would cost the company 10 multiplied by 1 minus 40%, that is 6%. So if there is a pending loan of say 10 million, the interest payable would be 1 million. And this is deductible for the tax purpose. Now suppose the profit of the company before interest was 10 million. It would have had to pay 40% of 10 million as tax if the amount of interest was not reducible. But now the company can reduce the amount of interest paid from its profits. So the profit on which the tax is payable is 10 million minus the amount of interest, which is 1 million. So now the taxable profit is 9 million. There's a 40% saving on the amount of interest of 1 million, which would otherwise have been payable as tax if the cost would not have been reduced from the profits. Hence, the cost of leveraging is always lesser in the countries and the regions with higher tax rates than in the countries or the regions with lower tax rates. Let's do a couple of questions. The first one says, which of the following statements is correct? A. The appropriate tax rate to use in the adjustment of before tax cost of debt to determine the after tax cost of debt is the average tax rate because the interest is deductible against the company's entire taxable income. That's not true. There are certain items of profits such as capital gains that generally have a separate tax treatment. So averaging the same would not be an appropriate thing to do. Then B. For a given company, the after-tax cost of debt is generally less than both the cost of preferred equity and the cost of common equity. Yes, they generally are. And C. For a given company, the investment opportunity schedule is upward sloping because as the company invests more in the capital projects, the return from investing increase. Oh no, that's actually opposite. It's actually downward sloping, indicating decreasing return as the investments increase, especially after a certain level. Hence, option B is correct. Moving on to the next question. .com, that's a weird name. Anyways, .com has determined that it could issue 1000 face value bonds with an 8% coupon paid semi-annually and 5-year maturity at 900 per bond. If .com's marginal tax rate is 38%, its after-tax cost of debt is closest to A 6.2%, B 6.4% and C 6.6%. Now solving this is a 3-step process. Since here the issue price is not equal to the face value, First, we have to calculate the semi-annual IRR or the internal rate of return of this bond. So for calculating the IRR, we have this information. We have an initial receipt of $900. Then we pay a $40 coupon every 6 months for the next 4.5 years and a coupon plus face value redemption at the end of 5 years. So there are 9 payments of $40 and a final payment of $1,040 at the end of 5th year. We'll use this information to calculate IRR on our calculators. Now the second step is using the IRR computed in the previous step, which is semi-annual, we annualize the same. And finally, the last step, we calculate the cost of debt by adjusting the same for tax effect. We'll do all these steps on our financial calculators very quickly. You have only 1.5 minutes to solve each question in the paper. So here's how we do it on our calculators. First, clear the calculator for any previous calculations. For that, press CF, then second, and then clear work. Then you start entering the data. For the initial outflow of $900, enter the amount and make it negative pressing plus minus sign. Then press the enter and down button. Then enter the coupon outflow of 40, press enter and down button. Now set the frequency to 9 because 10th or the last payment would be $1,040. Press enter and then down. Now enter the last payment of $1,040 and then enter and down. The frequency of this payment is 1, so just enter. Now press IRR button and then CPT to compute the IRR. This is the semi-annual internal rate of return. Now we'll analyze the same here itself. Divide this with 100 to get the decimal value and not the percentage value. Add 1 and now calculate the square of the same. Now we reduce from it the 1 that we added earlier. So we have an annualized internal rate of return of 10.91%. Now the final step, adjust it for the tax effect. We have a tax of 38% or 0.38 and 1 minus the tax is 0.62. So we'll multiply this value with 0.62. So here we have the after-tax cost of debt and it is closest to option C, that is 6.6%. Therefore, option C is correct. So that was LOS-B about the effect of taxes on cost of capital. Practice more questions on this topic so that you can solve them as quickly as possible in the exam. Remember, there's a time constraint in the exam and you all have to be really very quick. You can find questions for your practice on our website ProCFA.com. And if you have any problem, you can always contact us. We'll revert back as soon as we can.